好，欢迎大家再度来到水星兔的频道。那今天要简单跟大家介绍一支影片就是这个影片的主讲人就是下礼拜 Apex 会来到台湾的主管Vince 他是商业的发展经理，但他过去打 Apex 的成绩也非常的显赫那他在 Apex 里面出金呢也是大概有100万美金有那这一集他就是跟国外这个主持人呢就做了一个非常长的对谈那我应该会分3集的我就慢慢的翻，慢慢的把里面的东西翻成通顺的中文，那大家有空就简单看一下。他其实讲到很多，不管是策略执行上的这个实际的层面另外或是像一些心理上的调整，我觉得其实都还蛮适合大家去参考的就是应该很多人看了都会有一些启发吧所以简单来讲是这样，那就废话不多说，我们马上来看影片咯。
The main credential I want to start off with is you've made $1 million in a single payout. What a phenomenal feat. So I think this episode we're going to explore how that was done, the highs and the lows, and specific strategies. But first of all, Vince, all the way from the US, thank you for joining.
Thank you for having me.
There we go. So I wanted to first get right into it and kind of understand the process of that $1 million payout and the journey leading up to it, meaning to say, was there a lot of blown accounts beforehand? Was this your first attempt? What was that foundations before you embarked on this $1 million challenge?
Yeah, I want to set that stage for you because I think that's the interesting part of how I got there. So let's back up before my trading days. So I started a company in 1998 and 10x'd it and sold it in 2011 to a company in British Columbia and was in the sheet metal toolbox business. I built toolboxes in the US. After I did that, I went into the import-export business and actually traveled extensively in China. Been to China well over 200 times in my career. And in 2011 when I actually sold that company. In 2018, I'm in China when the Trump tariffs hit. I had a very large 8-figure contract with a US retailer for barbecue grills, and they canceled that contract because the tariffs essentially added too much to bring them back into the US. So there I am in Shanghai down almost $2 million. Because you had paid fixed costs. Because of the tooling I had put into it. And we had also done the first shipment or produced the first shipment that they were not going to take. And so there I am in Shanghai down $2 million going, how do I recoup $2 million? You know, I had the pressure of the Trump tariffs. And I sat there and I thought, what type of business is out there where I don't have to have a customer and I don't have to have a factory? What business is that? And discovered futures trading. And so that was probably the best, worst decision of my life.
So before that, you were not involved in the markets. The markets came to you at a bad time.
I traded stock, did some futures, options, but did not do futures.
Okay, so I want to start off with that because a lot of people, mostly people come into the markets, I'll say from zero, in the sense of maybe
I started at sub-zero.
Yeah, you started 2 million down, and even when people start at zero, they're just trying to get a bit of extra cash to pay their bills and so forth, and maybe leave their job. And it's always coming from a place of inspiration and work your way slowly to get towards that goal. You could have been in a state of with these financial anchors, emotional anchors, and when people chase an outcome and you got to pay off these debts, usually the market amplifies behaviors, and that can be a very quick spiral to blowing even more money, let's say. What kind of a mindset did you have coming into it, knowing you were X amount down and you wanted to recuperate it through the markets?
I had a mindset that I was going to make it all back in 30 days.
Oh gosh, okay.
I was going to figure out how to do that.
Okay.
And so the first step that I did is I put a couple grand into a brokerage account and blew it in 60 minutes. That was my first step in futures.
Sounds pretty normal.
And I did that again. I think I actually did that multiple times.
Wow.
And that's when I went out and started to look for any other type of way to get into futures. And that's when I discovered prop.
Okay. And when you discovered that and then you see this big opportunity, like everybody can see in front of them, okay, I get all this leverage, the cost ratio, etc. Obviously, I'm sure there was a big portion of education, understanding risk, understanding your mindset, because you're coming in as a beginner trader with a huge opportunity and a huge debt, I want to say. What was your roots to educating yourself and navigating yourself through the journey?
So I got on YouTube and I discovered Jim Dalton quite early and started to study market profile. And market profile is something that really interests me, still interests me today. It's something I use heavily. I like how it frames the day. I just like the picture it gives of the overnight session and the day session. And I discovered Fibonacci, took a couple courses on that, and you really use YouTube Academy, right? And a lot of courses.
It's interesting to hear. Yep.
A lot of it was free. I haven't paid a lot by means of buying courses and things. That's everything I did was pretty much come from YouTube.
You know, a lot of people feel that the lack of the reason their profitability is not there is because they lack information. And well, first of all, I don't even believe that's true. I feel like at some point, more information will not arm you further. It might confuse you further or leave you in a state of analysis paralysis, let's say. And sometimes it's better to get out of the classroom and start practicing and implementing. But at the same time, I want to say to them, like, we have the whole world at your fingertips. There's an infinite amount of knowledge. And when I was at university, I wasn't actually learning from the lectures or the textbooks. I was just watching YouTube videos from people that simplified it better than my professors, let's say. The internet raised me. I always say this. It's fascinating to hear. When you were consuming content online, obviously the online information can be a bit broken up and you got to go do a lot of digging. When you're in that mode of being a sponge and kind of taking a lot of information in and converting that towards a working strategy that you were using, what was that process like? Because I think a lot of people, especially watching the show right now, are used to consuming education online on YouTube. How can they take that information and turn it into a working strategy?
Well, you have to find something that interests you. There's a lot of strategies out there, and I always tell traders, someone else's strategy isn't necessarily going to work for you. If you're not interested in it, if it doesn't seem intriguing, if you're not curious about how it works, why it didn't work, then you're probably not going to succeed at it. And so there's a lot of strategies out there traders use that aren't interesting to me. They work for them. They do quite well. They've exceeded what I've done, but they're not interesting to me. And so I got to find something that is interesting to me and resonates with me on the chart.
Why do you choose the word interest? Like, why do you think the curiosity of a strategy is important for the success of a trader?
Well, there's a lot of people that are studying liquidity is interesting to me, and there's a lot of people study liquidity. It's a deep, dark rabbit hole that I don't have enough interest to really dive into it and fully understand it and utilize it. So to me, it's something that's interesting, but it's not relevant to my style of trading. I watch it, but it's not something that I feel like I need to take the time to do. Fibonacci was something that intrigued me because it's it appears so much in nature, and I'm going, well, there's something to this, and it was just that was intriguing to me and interesting to me from even outside of the world of trading. So how does this work? And it's a naturally recurring phenomenon, and it was just interesting to me.
Fair enough.
So
that curiosity led you down the rabbit hole to keep you digging down the rabbit hole, let's say.
Yes, yeah, and I continue to find new rabbit holes, but I always have to look at it and say, how is this going to help my current style, or is it going to hinder my current style? Is it going to take away from my current style? So you can get too many buckets of information that you're trying to haul around, and you got to figure out what works best and what resonates with you.
I'm really glad you brought this up because I want to echo it directly, and it's something I've said so many times, and I'm glad someone else is saying it too, is this idea of, I think curiosity is one of the most powerful drivers that we have. This whole platform for me that I built is because I was curious to have these kind of conversations. Even trading for me I had a path of being a dentist and university, and curiosity drove me elsewhere. I think curiosity can... in general, people don't have a passion. I think people are not born with a passion for the markets, but a passion is developed through curiosity, and that curiosity, those embers turn into a flame of passion when you start to fulfill your curiosity and start to get better at something, and it becomes that positive feedback loop. Getting into the things you were learning specifically and what was driving your curiosity, as you mentioned Fibonacci and so forth, what kind of advices would you have to someone that is like, I know Fibonacci, I know these things. What was the difference between surface level information and an applicable strategy? Kind of get into what was an ideal trade model for you, or how would you approach the markets from strategy to an actual execution?
Well, so it's interesting from the standpoint that I think every trader is unique in the perspective that not only do you have to find a strategy, you have to find a strategy that works with your lifestyle, with when you're available to trade. What time frame are you going to trade? What hours of the day are you available? What markets you're going to trade? And so I had to find something that I felt like would set up relatively quickly every day, because I still was holding down several other businesses and couldn't dedicate all day to trading.
And I guess neither was it your desire. You wanted to just make your money to get back to the business.
And so there was I'm a levels trader. So if I can draw a horizontal line on a chart, that's a level. So support and resistance, Fibonacci, the previous day's value, the initial balance, the opening range, those are all things that I watch very, very closely every single day. And there's really, the way I trade today, there's really only 2 trades that I ever really focus on, and that's a previous day's value area play, and that's the initial balance play. Those are 2 trades that I watch every single day.
So previous day value, I'm assuming that means a form of the average day of yesterday, or is it highs and lows of yesterday?
So I take every night, I mark off a chart, and I take the previous day's value, and that value is where 70% of the trading took place. And I
From a volume perspective.
Right. I draw a block on the chart that says here's where the previous 70% of the previous day's trading took place. When if price opens outside of that value area and it moves into that value area, on a 5-minute chart, I wait until a candle establishes in that value. And if it establishes in that value, there's an 80% rule that it's going to fill value. So if you're coming down into value,
sell it off.
Establishes and sells off, there's an 80% chance it's going to fill to the other side of value. If it comes up into value, 80% rule is going to fill to the top. That's one of the trades. So that's
Very
an 80% statistic. And Jim Dalton teaches that. And,
that's very interesting.
And from a market profile perspective, it's very interesting to look at. The other trade is the initial balance. The initial balance is the first hour of trading. So when the first hour has happened on the day, I have 2 lines on the chart. I have the IB high and the IB low.
Of that initial hour?
Of the initial balance. So that's the initial balance. When price comes back up and tests or goes down and tests the IB low or tests the IB high, there is a 90% stat that says it's going to reject it.
So essentially, when you've defined that range of the first hour, and then it comes back to test it, you just sell it at the open, stop loss at the high, and
there's a 90% chance it will reject it on the first test, not second test, first test.
Okay, let's explore both of these. So the first one is the 70% of the volume of the previous day. You mark it out as a point of interest or area. First of all,
it's a value area block.
That's let's say previous, on average, the average daily range as a proportion to the range of the 70% of the volume. Typically, what have you found that is a ratio? That the 70% of the volume is usually a 10% of that ADR, or is it usually a 50? Just to kind of know how big that zone usually is.
The zone varies dramatically. There's days that zone's extremely tight. There's days on a strong trending day, if we had a lot of volume and it was a strong trending day, those value areas can be a 200-point range. Those are days I love. Because
so you prefer the big zone ones because there's more room to trade.
Especially when we open outside of value on the next day. Because when we open outside of value on the next day and we move into value, that means that the value area play is in effect. If we open inside of value, that typically means a chop day.
I see.
So I really want to open outside of value, watch action move back into value, and then take the value area play.
And the second model, which is kind of like the range and then tap and go, have you found that you can tap and go and then use the first model as a zone that the 70% volume where it's magnetized towards? So you tap and go into the zone and then use the closure of the zone as your final take profit.
You can, absolutely can.
Okay.
And so on the value area plays, I'll give myself a little bit more room on those because I'm more confident in that. I mean, there's an 80% probability it's going to fill. There's a 90% probability on the IB trade. And so what's interesting is I have an IB indicator that plots it. I use NinjaTrader as my platform, and I use a Trade Devils indicator that plots IB for me on my NinjaTrader. And it has a stat down in the corner that tells you how many times that trade works over the previous weeks. It's alarming. We're talking, it's 80-90% of the time it works. Now, it's not that it's going to be a rejection and it's just going to trend the opposite.
I understand. It might just be a move,
but
bounce and go.
On NQ, if you can pick up a 10-point wick, that's a great trade. It's a great trade.
I want to explore exactly this because reactions don't necessarily lead to the market moving and reversing in direction, but that tap and go, catch a small amount, and the rest comes to break even. As we mentioned on stage at the summit, there's no cost of breaking even. You can hit break even all day. So I'm actually aligned with that. I'm doing certain things, I'm doing a difference, but with a similar philosophy of sharp stop loss, go for the volatility of the day, go for the session movement and be in and out quick because you're playing the risk reward game. So I want to first start off with the risk risk reward side of things, because you're mentioning there's a super high probability of reactions and potentially reversals, let's say. But I want to understand, with what parameters do you decide to execute? Because number one that comes to mind is with the degree of variability between that 70% volume being a large zone and sometimes super tight zone. And you mentioned the larger ones is the ones you prefer. How do you qualify which one is a tradable moment? What are the parameters you're adding on to make, let's say, this trader that I know has a high reaction rate a worthwhile rate for you to still enter? Or was it almost an everyday thing?
So what's interesting is everybody talks about risk reward, and I've never completely, I don't know if I completely understand every style of trading in that regard. I don't look at risk reward from a 1 to 5 or 1 to 4 or any of that. I look at it in terms of dollars and ticks. I come from the retail business, so if
do you do fixed position size?
I do fixed positions. So
okay.
I enter most, and I also say this, everybody looks at it and says, you know, I run a 100-point stop, for example, someone may say, and I ask them, why do you run a 100-point stop? Well, it's because that's their risk tolerance. I always look at it and say there's another factor to what stop size you should run, and that should be based on the confluence that you drew up to take that trade. If you spent the time to draw the proper confluence, you can probably run a lot tighter stop on that entry. Mm-hmm. If you just drew a couple lines on a chart and said, I think if price gets here, I'm going to try this, well, then you're going to probably have to have a bigger stop. So my stop sizes are driven off of the confluence that I started drawing up, because my trading day starts when the market closes the previous day. I start drawing up charts the previous day. And so the more time I take on drawing those charts up, and the more time I spend identifying levels that I want to trade on the next day, the tighter my stops are going to be. Mm-hmm. Because I'm more confident in those levels. I don't want to risk a lot more.
But when you are more confident, do you size up, or is it always a standardized?
I scale in, I never DCA. I will. So in the last couple of years, I've been entering with one contract and then I scale in. And that was a little bit difficult for me to do, because there's many times that I want to jump in with 3 or 5 contracts.
I see.
But what I started to do was enter with one, because I can give myself a little bit more room if needs be. And so I've typically run a 50 ticks stop on NQ, which is pretty tight. And I've been able to maybe expand that a bit because I'm only doing one contract. Mm-hmm. So then I like to scale in.
When you are scaling in, does your following position only come when the initial is break even?
So as soon as I can get a stop at break even, I do that, because I'm willing to get stopped out 100 times. Like I said,
it makes sense.
No one penalizes you for getting stopped out, right? Because if you're not going to be wrong 50 times on the day, you're going to get something out of it, right? And so I like to get the stop into profit as quickly as I can, but then I trail with confluence. I move stop as price moves through other areas of confluence that I've identified. But what's interesting about the stop, because I get this question a lot, stops, I like to use an analogy that stops are a little bit like American football. So let's pretend the stop is the pocket.
Okay.
Let's pretend you're the quarterback. The offensive line is break even. So the ball snaps, you're in the trade. Mm-hmm. Quarterback, you're the quarterback. You got the ball. You're looking, where's this trade going? Where's it going? What do I do? What do I do? You're in the pocket. The offensive line gets broke. They're coming after you. It's best just to go down in the pocket. Don't step out of the pocket. Mm-hmm. That's your strategy. That was where you entered. That's where you were comfortable. Just go down in the pocket with the ball. Mm-hmm. You didn't lose more than your strategy. Right. You stayed within your rules, and you can take another trade. Now, another analogy. That same thing. Ball snaps. Quarterback's got the ball. He's getting pressure. They're coming after him. They're going to sack him. He steps out of the pocket. Let's pretend that pocket was a 5-point stop. Mm-hmm. But he steps out and he backs up another 10 yards.
Yep.
You're another 5 or 10 points down, right? They come after you. You get sacked. What happens? Now you're down 3 times what your strategy was. You just broke the rule. And if you always think about that, you got to stay in the pocket. Right. The second you step out of that pocket, they're coming after you. You're naked in the market, right? You're on the mouse, not knowing what's happening. You're in the moment. Emotions are getting a hold of you. You can't figure out why you weren't right, and you're just pulling that quarterback back.
Right.
You're just pulling him back.
Making it worse and worse, yes. So the reason I kind of started off with the risk-reward one is it's usually the more common approach, but I'm completely aware that there's 2 ways to do risk. One is the fixed position size, and then you just add up your plus or minus ticks, and that's kind of your P&L decision making. And then another one is the risk-reward parameter. I find the people that do the fixed position size usually trade only one asset class or maybe 2 and have their fixed position size on each. I want to questioned this one because this is a decision I had for myself also. I chose to modulate my lot size and position size to always standardize my risk in a dollar amount. But if I have a X tick stop loss versus a bigger stop loss, I want to lose the same, let's say $1,000. But in your sense, if you're doing fixed position size based on how big your stop zone is, certain trades you may lose more money than other trades. And I guess that it balances out at the end of the month. But when you don't have a fixed loss per trade, does that have any effect on the mind to say, well, this trade I might lose 1,000, this trade it has a larger stop loss, I might lose 1,400. That non-standardized risk elements not amplified by more confidence in a trade, therefore sizing in rather it's just it was a bigger or smaller stop loss. How does that affect your system?
Well, like I said, I always enter with a 50 tick stop. And so,
so that is like a hard rule, or is based on the price action and some parameters?
That's pretty much a hard rule. So
with a bit of breathing room. Okay.
The only time I might flex on that a bit is if I'm entering on a value area play, because that's a high probability play, or the IB play, because that's a high probability play. But if I'm entering off of other confluence, fib confluence, unless it's off a really high time frame that I've identified, then I might give myself a little bit more. But if it's one of those things where I only have 3 or 4 things of confluence and it's not those high probability plays, then I'm going to enter with a hard stop loss of 50 ticks, and I don't change that. I'll let it get hit, and there's many times I'll exit the trade before it hits, because you kind of get that uncomfortable feeling. You're not liking the action. It didn't move quick enough off the level.
Yes.
Right? And so if I start seeing that, then I just close the trade.